Hello, my name is Leah Reinders. This presentation examines the unequal economic recovery that followed the COVID-19 pandemic. I will focus on how fiscal and monetary policy helped stabilize the U.S. economy, while also considering who benefited most from the recovery and who continued to carry the greatest economic burden. The COVID-19 pandemic created one of the sharpest economic disruptions in modern history. In response, the federal government and the Federal Reserve used aggressive fiscal and monetary policies to prevent a prolonged collapse. These policies helped stabilize consumer demand, credit markets, businesses, and employment. However, the recovery was not experienced equally. Gross domestic product and financial markets recovered relatively quickly, while many low income workers, renters, small businesses, and countries with limited fiscal resources continued to face long term economic hardship. This presentation examines the major policy trade-offs, the fall and rebound of GDP, the difference between financial and real assets, crowding out, money creation, rational expectations, international trade, and exchange rates. The central argument is that the pandemic response was economically necessary and largely effective, but its benefits and long-term costs were distributed unevenly. During the pandemic, policymakers faced trade-offs rather than simple choices between good and bad outcomes. Public health restrictions helped slow the spread of the virus, but they also reduced production, employment, consumer spending, and business revenue. The economic decline was especially severe for lower wage workers and for industries that depended on in-person activity. Emergency relief programs, including stimulus payments, expanded unemployment benefits, business support, and rental assistance, helped prevent even deeper hardship and supported consumer demand. However, these programs also required a major increase in federal spending and borrowing, which created longer-term budget consequences. The Federal Reserve also lowered interest rates and expanded liquidity to stabilize financial markets and credit conditions. These actions helped prevent a broader financial panic, but the benefits were not distributed equally. Households with savings and financial assets were generally better positioned to recover than renters, low-income workers, and families without a financial cushion. The central trade-off was that policymakers had to decide which risks to absorb immediately and which costs to postpone. Their actions reduced the danger of a deeper recession, but they also contributed to higher debt, future policy constraints, and uneven recovery. Gross domestic product fell sharply at the beginning of the pandemic because several major components of economic activity declined at the same time. Businesses closed or reduced operations, many workers could not report to their jobs, consumers cut spending, and companies delayed investment because of uncertainty. The Bureau of Economic Analysis reported that real GDP fell at an annual rate of 32.9% in the second quarter of 2020, following a 5% decline in the first quarter. The decline was especially severe in industries that depended on face-to-face interaction, including travel, hospitality, entertainment, and many personal services. Consumer spending is the largest component of GDP, so the sudden reduction in household purchases had a major effect on total output. Business investment also declined as companies postponed expansion and equipment purchases. GDP rebounded as essential work continued, businesses developed safety procedures, remote work expanded, and more workplaces reopened. Fiscal relief also supported household spending, while Federal Reserve policy helped stabilize credit markets and reduce borrowing costs. The rebound appeared especially dramatic because it was measured from the unusually low level reached during the second quarter. A rapid increase in GDP did not mean that every household, worker, or industry had fully recovered. Aggregate output improved faster than the financial circumstances of many lower-income families. Financial assets and real assets respond differently during an economic crisis. Financial assets include stocks, bonds, bank deposits, and other claims on future income. Their value depends heavily on market expectations, interest rates, and investor confidence. Real assets include homes, buildings, equipment, land, and productive businesses. Their value is tied more directly to actual economic activity and the ability to produce goods, services, or shelter. During the pandemic, financial markets recovered relatively quickly after the Federal Reserve lowered interest rates, purchased Treasury and mortgage backed securities, and expanded emergency lending programs. These actions reduced financial panic and helped restore confidence in credit markets. However, the recovery in financial markets did not mean that households and businesses had fully recovered. Many lower and middle income families experienced job loss, reduced income, and worsening financial conditions, while households that already owned stocks, retirement accounts, or other assets were better positioned to benefit from rising market values. This difference helps explain why aggregate indicators can appear strong while many people remain financially insecure. A rise in stock prices reflects improved expectations in financial markets, but it does not directly measure whether renters can pay accumulated debt, whether small businesses have reopened, or whether workers have regained stable income. The financial recovery was therefore faster and more visible than the recovery of the real economy. Crowding out occurs when increased government borrowing competes with private borrowers for available funds. In a typical economy, greater government demand for credit can raise interest rates and reduce private investment because businesses and households face higher borrowing costs. During the pandemic, however, traditional crowding out was limited. Federal borrowing increased sharply to finance stimulus payments, expanded unemployment benefits, business assistance, and other emergency programs. At the same time, private investment demand weakened because many firms were delaying expansion, reducing operations, or responding to extreme uncertainty. The Federal Reserve also kept the federal funds rate near zero and purchased large quantities of Treasury and mortgage backed securities. These actions increased liquidity and helped prevent government borrowing from driving interest rates sharply upward during the crisis. This does not mean that the borrowing had no cost. Higher federal debt may create future interest expenses and reduce fiscal flexibility. However, during the immediate crisis, the combination of weak private borrowing demand and aggressive monetary support meant that government borrowing did not strongly displace private investment. The more significant concern was the long-term debt burden rather than immediate crowding out. During the pandemic, the Federal Reserve responded by lowering the federal funds rate to near zero, purchasing Treasury and mortgage-backed securities, and expanding emergency lending and liquidity programs. These actions increased bank reserves and helped stabilize credit markets during a period of extreme uncertainty. It is common to describe this process as printing money, but that phrase is incomplete. The Federal Reserve primarily created reserves electronically within the banking system. By purchasing securities and supporting emergency lending facilities, it increased liquidity and made it easier for financial institutions to continue extending credit. These actions helped prevent a broader financial panic, lowered borrowing costs, and supported lending to households, businesses, and local governments. They also helped restore confidence in financial markets and supported aggregate demand during the crisis. However, monetary expansion also created longer-term concerns. Very low interest rates and large-scale asset purchases can contribute to higher asset prices, encourage greater borrowing, and complicate later efforts to control inflation. The immediate goal was to keep credit flowing, but the longer-term policy challenge was how and when to withdraw that support. Rational expectations theory assumes that households, businesses, and investors use available information to anticipate future economic conditions and government policy. They do not simply wait for a policy to affect them. They may change their behavior in advance based on what they expect will happen next. During the pandemic, this helped explain why the same policy produced different responses. Some households spent stimulus payments immediately because they needed food, rent, or other essentials. Others saved the money or used it to reduce debt because they were uncertain about employment, future income, or the length of the crisis. Businesses also responded to expectations. Firms that anticipated a prolonged downturn might delay hiring, expansion, or investment even when credit was available. Investors reacted quickly to expected changes in interest rates, inflation, and Federal Reserve policy, which helped move financial markets before conditions in the real economy had fully improved. This means policy works partly through expectations. Temporary support may have a weaker effect if households expect future hardship, inflation, higher taxes, or policy reversal. Government spending and interest rate changes still matter, but their actual impact depends on how people interpret the policy and what they believe will happen next. The pandemic exposed how dependent national economies are on international trade and global supply chains. Border restrictions, factory shutdowns, transportation disruptions, and reduced international demand interrupted the movement of goods and services across countries. These disruptions affected both import dependent and export dependent economies. Import dependent countries faced shortages and higher costs when access to foreign goods, energy, medicine, and production inputs became less reliable. Export dependent countries lost revenue when foreign demand fell. Countries that relied heavily on a narrow range of exports were especially vulnerable because they had fewer alternatives when global markets weakened. The effects were not equal across countries. Nations with stronger fiscal capacity, better health systems, diversified trade relationships, and more resilient institutions were generally better able to absorb the economic shock. Countries with high debt, limited fiscal space, weak infrastructure, or dependence on a small number of trading partners had fewer policy options available. The pandemic therefore demonstrated that economic isolation does not necessarily create resilience. In many cases, diversified trade and stronger international connections gave countries more flexibility. The broader lesson is that resilience depends not only on domestic production, but also on the ability to adapt when global trade patterns are disrupted. Exchange rates changed during the pandemic as investors, businesses, and governments responded to uncertainty, differences in interest rates, and changing expectations about national economic recovery. When risk increased, investors often moved funds toward currencies viewed as safer or more stable. Interest rate policy also affected currency values. When central banks lowered interest rates, financial assets denominated in those currencies could become less attractive to international investors. At the same time, countries with stronger institutions, greater confidence, or faster recoveries could attract more capital and place upward pressure on their currencies. Trade disruptions also influenced exchange rates. Export dependent countries faced weaker foreign demand, while commodity exporting countries were especially vulnerable when global prices fell. Countries with high debt, weak foreign exchange reserves, or limited fiscal capacity had fewer tools available to defend their currencies or support domestic demand. Exchange rate movements therefore reflected more than trade alone. They also reflected risk, interest rate differences, capital flows, confidence, and expectations about recovery. The pandemic showed that countries with stronger institutions and more policy flexibility were generally better positioned to manage currency pressure. The pandemic response prevented a deeper and more prolonged economic collapse. Fiscal policy supported households, businesses, and employment, while Federal Reserve actions stabilized credit markets, lowered borrowing costs, and restored confidence in the financial system. However, the recovery was not distributed equally. Financial markets and aggregate GDP recovered more quickly than many households. Lower income workers, renters, and families without savings were more likely to experience unemployment, income loss, housing insecurity, and lasting financial setbacks. The same pattern appeared internationally. Countries with stronger institutions, greater fiscal capacity, diversified trade, and more resilient health systems were better able to absorb the shock. Countries with high debt, limited resources, or narrow export dependence had fewer options and generally faced greater difficulty recovering. The central conclusion is that the pandemic response was economically necessary and largely effective, but stabilization at the national level did not guarantee equal recovery. The crisis revealed that aggregate indicators can improve while substantial hardship remains beneath the surface. Future policy should therefore be evaluated not only by whether GDP and financial markets recover, but also by how the benefits and burdens are distributed across households, workers, businesses, and countries.